Okay, chapter 10, cost volume profit analysis or decision making based on the cost volume profit analysis. Course is still accounting for managers, and learning objectives are quite few here. But before we do that, let's do what kind of analysis is this? This analysis is going to give us opportunity, or going to give you opportunity to understand what will be the effect that you're going to have on the profit if we change the cost or if we change the number of the units that we're selling, going up or going down. Now, this is the critical factors in the management in order for you to plan and to make decisions on which product you should sell, which product you should not sell. And again, we're going to considering the interrelation and how these 5 elements communicate or affect each other. First one is the volume of the level of activity. How much I have to sell? Do I have to sell 10 pieces or 50 pieces? How much is it? How much is my unit sales price per unit? How much is the single price for one item? How much is the variable cost, again, per unit? Then we're going to see how much is the total fixed cost. And then we're going to see what's the sales mix. Underlying assumptions, in order everything this to work, we have to do some assumptions. First one is the cost and revenue behavior are linear. What that means is they behave and we can predict them in the straight line. All the costs can be classified as either fixed, either variable, nothing else. So we are super black and white in the cost. If it's not variable, it has to be fixed. If it's not fixed, it has to be variable. The other thing is the changes in activity are the only factor that affects the cost. So the only thing that drives the cost is the number of the units that we're selling or not selling. The next thing is inventory level in the company stays the same. So whatever we produce, that's how much we're selling. And if we have a mix of few products, that mix of the few products doesn't change. So whatever proportion we're selling, that's how we're selling, and that sales mix doesn't change. In order to understand this, we have to prepare income statements. An income statement, we're going to prepare it in the form of the cost volume profit analysis usage. What that means? That means in every, let me open one Excel spreadsheet, and I'm going to show you quickly how this is going to work. What you have to do on Thursday, you have to show me the income statement for the company. I know you cannot see because it's too small, but I'm going to make it bigger just in a second. So you have to prepare the income statement for the company that I'm going to give you on the assignment. So the income statement should look like a revenue or sales, or whichever. You can use those one interchangeably, it doesn't matter. Then we're going to have cost of goods sold. This is the standard cost of goods sold. Once you get the cost of goods sold, then you can calculate the gross margin. After the gross margin, you're going to have operating expenses. And once we deduct the operating expenses, we're going to have the operating income. That's the traditional income statement. This is called traditional income statement. Revenue, cost of goods sold. This is calculation. So if let's put some numbers here. If the revenue is 100 and cost of goods sold is, let's say, is 20, gross margin is gonna be 100 minus 20 or 80. Then we're going to have operating expenses. Let's say operating expenses are 40, and we're going to have this one minus that one, and now operating income is going to be 40. Right. So now, how are we going to, for the purpose, what we're doing with the cost volume profit analysis, what we're going to do, we're going to grab this cost of goods sold, and we're going to grab the operating expenses. Those two together, as you can see, the total cost of goods sold is 20 and operating expenses are 40. The total is 60. So what we're going to do now, we're going to take a look at those costs, and we're going to find out the only way they can behave for our purposes is as a variable cost and fixed cost. That's it, nothing else. Revenue cannot change it because revenue is revenue. So once we do that, we may find out that, let's say, our variable cost is thinking of 40, and our variable cost is 40, fixed cost is 20. We may find that one too. Now we cannot, again, I cannot change the total cost. The total cost is always going to be the same. But now we're going to have a new income statement. This is traditional. Then we have now a new income statement, which income statement is going to be contribution margin income statement now. And it's also going to start with the sales. Again, I cannot change the sales. I'm sorry. Change is going to be the same. Sales going to be 100. But now my cost will be presented into the variable cost. So we're going to have here variable cost, which variable cost will be 40. Then after that, I'm going to have new calculation, which will be contribution margin. Which in my case is 100 minus 40. And after that, I'm going to have the fixed cost of 20. And my operating income is going to be exactly the same. I cannot change it. Don't forget, I cannot change the income. I can do the new classification of the cost instead of cost of goods sold to be so again, I cannot change the cost because cost already happened, but I can change the classification to the cost. Total cost always gonna be the same. But now I have new classification. Instead of cost of goods sold operating expenses, now I have variable cost and fixed cost. And my operating income is still gonna be the same, which is $40. Make sense? So now, with that operating income, new income statement, which is prepared by the variable, split the cost and the fixed, now we can start working on that one. Now let's go back to the slides and see how the slides dealing with this particular case. When we have to split the cost, and what they're saying is that the slides give you this cells, the income contribution, cost volume profit income statement or contribution margin income statement. It's going to be cells. We're going to have a different variable cost, but again, there will be total variable cost. After variable cost, we have a contribution margin. After that, we're going to have fixed cost, total fixed cost, operating income. So basically, We're going to classify all the costs as either variable and fixed, and we're going to get revenue minus all the variable costs is going to give us contribution margin. And once we deduct the fixed cost from the contribution margin, we're going to have operating income. Now, example for this company will be, again, sales are sales. Then we're going to have variable cost. And we're going to have total unit variable cost. And after that, we're going to have monthly expenses. Now, what's the interesting with the cost? If you still remember, variable cost per unit always stays the same. Fixed cost in total also stay the same. Now, if the variable cost per unit and sales price per unit are still stay the same, what drives the sales and what drives the variable cost? Only the units that we're selling. Fixed cost is a fixed cost. So now what you can see the problem is, I have my fixed cost, monthly fixed cost. I know that I'm selling my smartphone for $500. I know the smartphone costs me, every smartphone costs me $300. So from every single smartphone, I'm generating contribution margin of $200. My total fixed costs are $200,000. Now the logical question is, how many cell phones I need to sell in order to be cost free or not to lose money but to cover my expenses? That's what we're trying to do. So now the contribution margin from this example, if we have to calculate it, again, it's going to be unit sales price minus unit variable cost. So every unit is going to contribute in our company $200. If we know that we're selling 1,600 units, then that means that our total sales will be $320,000. Now the question is the $320,000 sales enough to cover my fixed cost? Yes, because the fixed cost is only $200,000. So let's see how this is going to be. If we're selling 1,600 units, 500 each, $800,000. Now, unit comes with the different cost, variable and fixed. Variable cost, I have direct material, direct labor, sales commissions, and administrative expenses. Once I combine those costs, my costs are $480,000. So, if I sell 1,600 units with the sales price of $500 and deduct my costs, my contribution margin is going to be $320,000. My fixed costs are fixed costs. As you can see, the fixed costs, they're not moving. Here, my fixed costs are $200,000. Here I have exactly the same $200,000. So my operating income now is $120,000. So what we can do? First one is to calculate how many units we need to sell in order to cover our fixed cost or to be cost free. Now, the one thing that we have to remember is every unit that we're selling comes with the sales price and his own cost. So if I increase the sales, that's going to increase the total sales, but also it's going to increase the variable cost, but it's going to increase the contribution margin. If I decrease the sales of units, that's going to increase the total sales, that's going to increase the variable cost, but also it's going to increase the total contribution margin. In this case, let's see, we're selling enough units to cover our fixed cost. Now the question is, how many units do I need to sell? If every unit give me $200, and I already know that my fixed cost is exactly $200,000, maybe if I sell 1,000 units, $200 each, is gonna give me $200,000, which gonna cover my fixed cost. And that's what we're doing. If we get the fixed cost, and if I divide it by the contribution margin for that one unit give me, I'm going to come up with the number of 1,000 smartphones which I need to sell in order to cover my fixed cost. What's going to happen if I sell one additional unit? Well, if I sell 1,001, the contribution margin of that additional unit is going to come directly to my operating income. Why? Because with 1,000 smartphones, I'm covering my fixed cost. If I sell one additional, $200 coming to my pocket now. So every additional unit that I'm selling is going to give me additional $200. So a company can increase the contribution margin. How? How can increase the contribution margin? We have to think which of those costs are affecting or are related to contribution margin. Now, what is the contribution margin? Contribution margin is simply sales minus variable cost. And that's equal to the contribution margin. So, a company can achieve increase. So I want to increase this contribution margin. If the fixed costs decrease, is that affect my contribution margin? Well, obviously it's going to be hard because the fixed costs are not part of this equation for the contribution margin. If the fixed costs increase, is that going to affect the contribution margin? Again, fixed costs are not part of this equation. Now let's think about it. What's going to happen if the variable costs decrease? Is that going to increase the contribution margin? And let's think about the B. If the sales price decrease, what's going to happen with the contribution margin? If I decrease this sales price, so let's say here, let's put some number. My sales price is 100. My variable cost is 50. My contribution margin is 50. Now, if the variable cost increase by knowing that this is my variable cost, what's going to happen? I'm going to have 100 minus 40. It's going to be equal to 60. Now the question is the contribution margin increase? Yes, it did. Right? So the other option is to decrease the selling price. Let's change the selling price. How can I change the selling price? Sorry, right here. I'm gonna go under here on this scenario, and instead of 100, my selling price now is 90. My variable cost stays the same. It's gonna be 50. Now what's happened with my contribution margin? Become 40. Actually, this one should be related to this scenario. What's happened with the contribution margin? Did it increase or decrease? Obviously decreasing. So if I decrease the selling price, is that going to help me to achieve this? No. So that's how we should solve these problems. So obvious variable cost, yes, decrease. Now, the contribution margin ratio will be simple percentage. How can we get this percentage? Sales are always 100%. So we're going to express everything as a percentage of sales as we saw in the ratio analysis. So if we get the contribution margin, which in our case is, since the sales price was, if you still remember, this, my sales price was $500, my variable cost is $300, so my contribution margin is 200. So as a percentage, going to be 200 divided by sales, which is $500, and that's going to give me simply 40%. Now the question is, what that 40% means to me? That 40% simply means for the every dollar of sales, you getting for every single dollar of sales, sorry, let me go back a little bit. That transfer to 40 cents of contribution margin. Now you're gonna ask me what's happened with the 60, because $1 is 40 contribution margin. What's happened with the 60? Well, the 60 is gonna be dollar 0.60. That's gonna be your variable cost. That's with the percentage. So now, how are we going to calculate for the income statement? Again, the ratio. You're getting the contribution margin per 1 unit divided by the sales price. It's going to give you the ratio. Let's see how we're going to this. If the company sales increase with $100,000, what's going to happen with operating income, knowing that contribution margin is 40%? The first thing that we have to think is, are we above break-even point? So let's take a look here. Currently, I'm on the break-even point. What that means? That means I'm selling 1,000 units. If I'm selling 1,000 units, my sales are 500,000, variable cost 300,000, contribution margin is 200, fixed cost is 200, and I'm break even. I'm not making profit, but I'm not losing money. Now, what's going to happen if my sales increase with $100,000? Well, since we know that the contribution margin is 40% of the sales, of the $100,000 increase in sales, we're going to see only 40%. 40% is $40,000. So only $40,000 going to come to us. So if we increase with $100,000, sales going to be $600,000. Variable cost also is going to increase because the variable cost 60%. So out of 100,000, 60,000 is going to go to the variable cost. That means the contribution margin is going to start live only 40% or $40,000. Operating income is going to go with $40,000. So in that case, what is the contribution margin? What's the formula for the contribution margin now? Obviously, sales revenue less variable expenses. Now, sales revenue, how about sales revenue less fixed and variable expenses? What will be that? Sales revenue, let's go here. Sales revenue minus variable expenses, that's your contribution margin. How about sales revenue minus fixed cost and minus variable cost? What will be that? Thank you. That's exactly what it is. Operating income. Thank you. That's great. Let's go with the break-even analysis. The break-even analysis, this is a simple calculation, mathematical equation, which is going to help us to understand what's going to happen if we increase the profit or decrease the profit. How much we can decrease or how much increase. And how the sales affect our profit. In order to start this, we have to find some equations. The equation to determine the break-even, the sales dollars, is going to be, you know what, let's go to Excel spreadsheet. Let's go to Excel spreadsheet and start working with the Excel spreadsheet. Okay, so let me share my screen. Okay, make some adjustments. Let's go here on the Excel spreadsheet. Can you guys see my Excel spreadsheet? Okay, excellent. Let's start working now to see what is what. Now, let's start with sales. Sales, as we already know, sales, let's stay with per unit. First one is per calculation will be per unit. Let's pretend that our sales per unit is $100. Variable cost per unit is, let's stay with $60. Now, our contribution margin in this case, it's going to be simply 100 minus 60. That's $40. Then we're going to have the variable cost, which variable cost will be one big chunk of money. Let's say the variable cost in our company is $3,000. So once we know this, we can start working. First thing first, as a percentage, if we have to express a percentage, sales out of sales are 100%, always. Then we're going to the point. Well, how about the variable cost? Well, the variable cost is going to be 60 divided by sales, or it's going to be 60%. And what's left for the contribution margin? Obviously, contribution margin is going to be 100 minus 60%, or it's going to be 40%. So that means for every dollar of sales, we're going to get 40 cents. The 60 cents we needed to cover the variable cost for the unit that we sell. Okay, so that's good. Now the question now is, how can we make the profit? Well, the profit, as we already talked in all operating income always going to be equal for my sales minus variable cost and minus fixed cost. Now, so if I want to make profit, let's go here profit. If I want to make profit with my sales, I have to cover the variable cost and I have to cover my fixed cost. That's the only way I to make a profit. Otherwise, I'm not going to make the profit. So, but my sales price per unit stays the same. So how can I increase the sales? By selling more units. That's the only option I have. if I sell more units, now let's say if I sell 10 units, what's going to happen now? My sales going to be 100 times 10. My sales going to be $1,000 now. But my variable cost also is going to increase. Why? Because I'm selling those 10 units that I'm selling, they're coming with cost. And my cost for those units is $600. So my contribution margin in this case is going to be $400. Now the problem is that my fixed cost, in total, they're going to stay always the same. They're $300. Obviously, selling 10 units is not going to help me. That's why in the business, first, what you're asking yourself is how many units I need to sell in order to cover all my costs. Which is the cost? The cost is the variable cost and the fixed cost. What we know about the variable cost? Well, the variable cost always gonna increase, always gonna be half a variable cost per unit time number of the units that we're selling or the quantity. Well, the same is applicable to sales. My sales always gonna be equal to the sales price per unit time quantity of units that I'm selling. Let's make it this not capital. So, but we already know that sales minus variable cost is contribution margin. Do we? Let's see who is the person now who's talking. And cut the mic. So, we already know that sales minus the variable cost is going to give us contribution margin. So if I put this one here, this is sales, this is the variable cost. So what's going to happen? Out of those equations, what I can say that my contribution margin is going to be equal to the contribution margin of 1 unit time number of the units that I'm selling. Make sense? So the only way to increase my contribution margin, if the sales and variable cost stay the same, is to change the number of units that I'm selling. Now the question is, how many units I need to sell in order to cover my fixed cost? So let's go now come up with the equation for that. First, what we need? We need our profit to be equal to 0. If the profit equal to 0, that means sales minus the variable cost and minus the fixed cost should be equal to 0. But from these formulas, we already know that sales minus the variable cost is contribution margin. Correct? So if I put this formula, I can expand the formula. I can go with the contribution margin minus the fixed cost should be equal to 0. So the only way I can get the break-even or 0 profit is when my contribution margin is equal to the fixed cost. And this coming to the point, how many units we need to sell? In order to my contribution margin to be equal to the fixed cost. Well, let's think about it. We already know that sales contribution margin, we already know the contribution margin is equal to sales minus the variable cost. And we already know that the contribution margin is equal to the contribution margin per unit time number of units that we're selling. Make sense? So if I know that contribution margin is equal to contribution margin per unit time the number of units that I'm selling, I can substitute it in this formula. How is the formula now going to look like? I'm going to have a contribution margin per unit time number of units should be equal to my fixed cost. From this formula, can I express how many units I need to sell in order to cover my fixed cost? And that should be straightforward. Number of units should be equal to fixed cost divided by contribution margin per unit. So let's see if this actually works. My fixed cost is $300. Let's try to substitute in this formula and see what's going to happen. My fixed cost is 3,000. My contribution margin is 40. So if I apply the now formula, Q of units should be equal to 3,000 divided by $40. Or the contribution, the number of units that I need to sell should be equal to, I don't want that formula to repeat itself. I just want to get the actual calculation, which is 3,000 divided by 40, and I need to sell 75 units. And now you can tell me, ha ha ha, very funny. Teacher, you're very funny, but we don't believe you. So what we have to do, we have to test this formula. How am I going to test it? Well, very simple. I'm going to flip it here. And what I know that my fixed cost is $3,000. So once I know this information, I can start working with my numbers. So if I sell 75 units, what's going to happen? Let's delete those ones because I want you to see the calculation. So I'm going to delete everything before I go with this. If I sell 75 units, my sales price per unit is $700 times 75. My sales will be $7,500. My variable cost is going to be 60 times 75 units is going to be 4,500. My contribution now is, as you can see, my contribution margin is exactly $3,000. How much was my fixed cost? Fixed cost is $3,000. So if my fixed costs are $3,000, how much is my operating income? In this case, operating income is zero. So what that means? That means this formula works. So if you want to find out how many units you need to sell in order to get the break even, find the fixed cost divided by contribution margin per unit. And you're going to see how many units you need to sell in order to come up with the operating income, which is zero. Now, the other thing that you can, or the other purpose that you can use this formula is very simple. Now, if you're paying, let's say, $140, you're paying $140 for your Compass card. And you're paying for two zones. And you already know that the day trip, or not the day trip, a single trip for two zones is, I believe, is 4 point something, let's say $4.25 for two zone. This is the two zone monthly pass. And here you have two zones again, but single ticket, not three, two. Two zones, but now we're playing with the single ticket. Now the question is, how many times you need to ride the SkyTrain in in order to make this two zone monthly pass worth? So what we're gonna do? 140 is your fixed cost. 425 is contribution margin. So that's how much is you getting for single trip. So the number of trips that you need to cover your fixed cost, it's going to be equal to $140 divided by 4.25 single fare. Let's change this because it's going to bother me and it's going to ask me all the time for this formula. So let's put it this way. So the number of trips that you have to take, it's going to be equal to 140 divided by 425, or it's going to be 32.941, or if we round the numbers, 33 trips. What that means to you, that if you ride the SkyTrain 33 times per month, it makes sense you to get two zone monthly pass. If you're riding the SkyTrain less than 33 times per month, you better stay on the single ticket. Why? Because you're gonna pay less. If you ride more than 33 times, then the monthly pass definitely makes sense. That's how you can use this contribution margin idea. Make sense? So that's with the number of units. Let's go with how much sales you need to generate. That's another equation. How much sales you need to generate in order to uh, get the break even. Let's say now my fixed cost is not 3,000. My fixed cost in this case will be $5,000. How much should be my sales in total to cover my $5,000 fixed cost? We're gonna start with the contribution. We know that the contribution margin here has to be equal to fixed cost. Or here I have to get 5,000 in order to cover my fixed cost. Otherwise, I'm not gonna get operating zero. So what I know is if I do contribution margin time 1 equal to the fixed cost, am I changing the formula? What do you think? No. But I can say that 1 is equal to sales divided by sales, correct? If I get sales divided by sales, is that 1? So now I can have a new formula. New formula will be contribution margin time sales divided by sales should be equal to the fixed cost. Now, once I know that, what I can do is now break the cells, and what I'm going to have? I'm going to have cells times contribution margin divided by cells should be equal to fixed cost. But hold on a second. Cells, contribution margin divided by cells, that's contribution margin ratio. Then what I can do is come up with a new formula, which is cells times contribution margin percentage should be equal to the fixed cost. So how much should be my cells in this case? My cells should be equal to fixed cost divided by contribution margin percentage. So let's think about it and let's try the formula. My cells should be equal to, if my fixed cost is 5,000 divided by contribution margin is, we already know, is 40%. How much should be my cells? Should be equal to, in this case, will be equal to 5,000 divided by 40%. My sales should be equal to $12,500. If my sales are $12,500, that means I would be able to cover my fixed costs, which are $5,000. Let's see if that's going to work. So I'm going to grab this part again, and I'm going to work with this part, but right here. So my sales, in this case, and operating income, I'm going to copy it from here, move it right here. So the formula says my sales has to be $12,500. So if my sales are $12,500 and I know that my sales are 100%, I also know that my variable cost is 60% of the sales. So how much will be my variable cost? So here I'm going to chase contribution margin ratio. I don't need this one. So in that case, my variable cost should be 12,500 times 60%. Or my variable cost $7,500. Once my variable cost is $7,500, my contribution margin is 5,000. Is that enough to cover my new fixed cost, which is 5,000? Obviously, it is. So what that means? That means this formula works. So this is the second formula, which is important for you to know. How can I get the sales at the break-even point? Simply divided by fixed costs on the contribution margin. So for that reason, what I want you to pay attention is both formulas, we're using the fixed cost as a denominator. In both formulas, we're using the contribution margin as a denominator, but different contribution margin. If we want to find out how many units we need to sell, we need contribution margin per unit. But if you want to find how much the total sale should be, we need the contribution margin ratio. Once we get those one, we're done. From here, from those two formulas now, what we can do is we can build and go further. Now, in the scenario that we're making $3,000, that's excellent, but now I want to make a profit. Let's say I want to make $5,000 profit. I know that my sales price is $100, variable cost 60, $60 and my fixed cost is $3,000. But I want to see here $5,000. What should I do? Well, I'm going to use exactly the same formula, but where the fixed cost is, I'm just going to add the income that I want. I'm just going to add this $5,000. And I'm going to run the calculation again. So what will be my calculation now? Number of the units I need to sell. It's going to be equal to fixed cost, which is 3,000. Bracket, I'm going to have 3,000 plus the 5,000 profit that I want divided by contribution margin per unit. So I need to sell 200 units. If I sell 200 units, then my operating income is going to be 5,000. Let's see if that's going to be correct. If I put here 200, am I going to get 5,000? Well, magically I'm getting it. So if you want to achieve some operating income, what we have to do is to add that income to the fixed cost. Same thing is applicable to the sales formula with the sales. Let's say I want to achieve sales of, no, my operating income I want here to be $15,000. I want that $15,000. So how much should be my sales? Well, again, what I have to do is to add that $15,000 in my equation and run the calculation again. Once I add the $15,000, I have to run the calculation again. So what will be that? That will be equal to bracket fixed cost. My fixed cost here was 5,000, right? Let's go with this one, but I'm going to change it. Plus 15,000 divided by contribution margin ratio is going to stay the same. So let's see, this one is 5,000. So my sales, in order to achieve 15,000, when my fixed cost is 5,000, has to be 50,000. So if I put here 50,000, I have to get operating income 15. Let's see if that's going to check. Yes, it does. Why? Because out of those $50,000 sales, only 40% is going to stay as a contribution margin. But the 40% of the 50,000 is 20,000. I'm going to cover my fixed cost, which is 5,000, and the rest is going to stay for me, 15,000 in my operating income. Now, the other thing that we can do is with this calculation, so now I have a break even in number of units. And I have where I am. So currently I'm selling, let's say pretend currently I'm making $5,000, but my break even is of 75 units. So if I have here only 75 units, I'm gonna be break even, but I'm selling 200. So what is my margin of safety? So currently I'm selling 200 units. My break even of number of units is 75. So the difference is going to give me my margin of safety. Or my margin of safety in this case is going to be, let's get it from here and paste it here. My margin of safety in this case is going to be 125 units. So what that means, I'm 125 units in sales away from the break-even point. So if my sales drop with 20 units, I don't have to worry. If my sales drop with 50 units, I don't have to worry. So let's go now to the slides and let's repeat those one in the light of slides. and see how the slides dealing with those calculations. Again, equation, sales is equal to sales price per unit times number of units. That's equal to the variable cost per unit time units that we're selling plus total fixed cost. So once we run this calculation, what we're going to find out here for our example is that if we want to come up with the break even, and we don't know how many units we need to sell, we have to get the fixed cost divided by contribution margin of 1 unit, and it's going to give us number of units. So if I sell 1,000 units, that's going to be enough to cover my fixed cost. So the break-even point in units, always the formula again will going to be total fixed cost divided by contribution margin of single unit. Now, if we have to work with the ratio, then we have to work, it's a dollar amount, we have to get the contribution margin ratio to come up with the sales. So that's how we have those two important formulas. First one is fixed cost divided by contribution margin per unit is going to give you the number of units that you need to achieve in order to cover all the cost. But fixed cost divided by contribution margin ratio is going to give you the total sales that you need to achieve in order to cover all your cost. Let's see how's the graphic for the fixed cost looks like. This is the graph of the cost volume profit analysis. How we can read this one? First one is the green one is the fixed cost. Fixed cost, as you already know, they starting at some point. Then, once you start selling, the variable costs start coming. What you need is with your sales, you to achieve enough sales, so the contribution margin of the total sales to first to cover the total cost. This is the break-even point where the contribution margin from the sales cover the variable cost already and the fixed cost. After that, you're on the profit side. How much will be the profit for single units? The contribution margin for that unit. Target operating income is if you want to achieve some amount as operating income, what you have to do, run the formulas, but add it on the nominator side or add it to the fixed cost. Divided by if you want to find number of units, divided by contribution margin per unit. If you want to find it as the total sales, divided by contribution margin ratio. Again, this company, they want to achieve $120,000 profit. So how many units they need to sell? 1,600 units. If they want to see how much the total sales should be, again, add it to the fixed cost, divided by contribution margin ratio, and they're going to find out that their sales should be $800,000. If you have to put the tax rate, then become a little bit more complicated. Margin of safety, let's go with the margin of safety. Margin of safety idea is the one that I explained on the Excel spreadsheet, is simply the safety zone that your business in. So you're comparing the current with the break even. And once you see the actual sales compared to the break even, it's going to give you how far away from the margin, from the break even point you are. And that's going to give you margin of safety. This one you see it as a total sales. You can express it as a number of units. That's also you can express it as a percentage. Give the margin of safety $250,000, where the actual sales are 750. So you are 33% above the break-even point. Now, for the rest, we're gonna do in the class. So that's where I'm gonna stop now.